Well, welcome to the Monday Money Tip Podcast presented by Fully Funded Life. My name is Joseph Sangle, and we are committed to helping you live your fully funded life with practical, right now relevant tips. Today, I'm joined by my co-host, Megan Hibbard. Are you fired up today?
Fired up. Happy Monday. Today's episode is number 307. And we are talking about mastering debt, loans versus credit card debt.
Yeah, we're going to explain the difference between like regular loans, mortgage loans, car loans, things like that. Loans from mom and dad. There's a big difference. And credit card debt. And it's going to be really important. Now, I do want to just acknowledge a couple things right at the start of the podcast. Many of you have listened for a long time. And I am loving having my co-host back here. I think we've done about a dozen of these podcast episodes since you've been back.
Yeah.
How's it feeling? You feeling good about it?
Yeah.
Yeah.
I like being back.
That's great. So I would love for you to give a shout out to Megan for being a part of the podcast. Just leave a comment saying how glad you are to hear her kind, calming, soothing voice as a response to my aggressive, do it now, mean voice sometimes. Sometimes sounds mean.
You're not mean.
Sometimes I'm encouraging. Sometimes I feel like I'm a little aggressive.
Well, you need to change that because we always say you are encouraging and helpful.
Okay, I'm going to change that. I change it. It's amazing. Change has come. Okay, so we're on episode number 307, and we're talking about mastering debt. And, you know, a lot of times people are really confused about what debt is really. In fact, I always say people reveal their financial education to me by the questions they ask. And this is one area where I realize we're at 101 levels. And I don't say it in a mocking way. I do not mock it at any level because that's why people will not embrace financial education. They know that they're at 101 levels and a lot of people mock them. Yeah. So it allows me to adjust how I respond to them. And when they say, yeah, I have my power bill debt. And I'm like, my brain goes just like I just did. Like, you have debt on your power bill? And what they're really saying is I have a bill.
Yeah. Because
they're not past due on it. But they're interchanging a bill due as debt. So debt really is an obligation to repay money that you've borrowed in the past. That's what it is. So it is not your power bill. It's car loans, it's truck loans, it's boat loans, it's Harley loans, it's mom and dad and my sister and brother and my friend loaned me money in the past. With some agreement to repay in the future. Yeah. Okay. Whether that's been clearly defined or not, well,
hopefully
that leaves it up there. And that's where we come to the difference between, you know what, a regular loan, an installment loan versus a credit card debt, which is revolving debt. Let's explain it.
Yeah.
So explain to everybody what installment debt is. I financed the car. What is installment?
Yeah, you're paying payments each month. So you finance the truck and now maybe every month you're paying X amount of money. You're paying interest on it.
Yep.
Maybe you got it at 0% interest.
Yeah.
But it's an installment. So every month that bill is coming.
So you pay it in monthly installments.
Right.
And it is generally the exact same number until that loan is completely repaid with the interest. If there was interest. Okay. So many people will do an installment loan for a car. That's the most common one they know when they first start out. And they go in to buy the car and they don't even really care what the loan is, how much the loan is for.
Most of the time, I feel like you look at how much is the truck?
No.
No?
No. See, you just witnessed. Zoom in on Megan. Look at this face. You zoom it in. This is the face of a person who's been up on the ladder a long time, okay?
That's what I look at.
Tell me if I'm right, because I know I am. You ready? When people go in to buy a car, they do not care how much it costs. They want to know one thing. How much is the payment? Because they're like, I need this to fit my budget. In fact, car salesman comment.
No, I thought you were saying they need to look at how much it is monthly, but they don't look at it. Okay. That's what I thought you were saying, which is why I was
I'm just right.
I know. No, I agree. You are right. They they want to know.
I got to go back to my encouraging. Change had not come.
No, when you're paying monthly installments, you need to know how much the monthly payment is.
Yes.
But I feel like sometimes it's easy to go in and say, oh, well, it's just a $35,000 car. It's fine. I'll pay it monthly.
Yeah, because the $425 payment.
But you don't necessarily.
For 84 months.
But it's easy to not necessarily make the jump to, oh, well, that much is how much I have to pay monthly.
So we kind of veered off.
That's what I was saying. I didn't want people to think that I'm ignorant in this situation.
So we're talking about installment versus revolving credit. So here's the key difference between credit card debt and regular loans, installment loans. Installment loans, you get approved to borrow the amount of money. Let's say for a car, $35,000. The $35,000 is transferred from the financing bank organization to the car company that sold you it, and you get the car. Now you've agreed to repay the money. Once you have fully repaid that loan, so there's one approval, you pay it back, you have to get an approval again to borrow money again, okay? That loan terminates upon selling of the vehicle and the settlement of the loan. Revolving credit card debt, is you get an approval for a certain credit limit. You do not have to take that credit limit immediately. You do not have to borrow it. And you do not pay interest on it until you use it. And whatever amount you've borrowed, which is your credit card balance, that's what you pay interest on. And if you pay it off completely, you can go get it again the next month. You can go get it again the same day. You do not need a new approval. So that's the really big deal difference between an installment loan and a revolving credit loan, is one requires an approval every time you want to go get the money. And it is distributed, that cash is distributed the moment you borrow it. Installment loans, the car loans, the boat loans, I borrowed money from mom and dad. Revolving, I can just keep going and getting it. There's no multiple approvals. Did I explain that clearly?
Yeah. And I think a lot of times with the revolving credit, people are like, well, they gave me this much amount, so I just got to spend it.
Yeah.
Well, you don't have to, and you need to spend what you can pay off.
And it's really important to think about this because the terms are different. So you want to understand the terms. So when you think about an installment loan, most of them are fixed terms. Now, some mortgages have fixed terms for 7 years and then they become floating or balloon payment. But for most car loans, the rate is fixed.
Right.
For most boat loans, the rate is fixed for the term. Okay. However, credit card rates, they can vary.
Yeah.
They float based upon, and it will say the terms based on the LIBOR, London Interchange Banking Overnight Rate, or they're pegged to some other federal overnight funds rate. Whatever it is, the credit card debt, the revolving credit is floating. Which
makes a 0% balance transfer credit card so much more appealing because, it has a set, usually 18, 20, 22 months, whatever it is, that it's 0%. But and so it does change, yes. But for that set amount of time, this is what I'm going to have to pay.
And so this is a term, just to explain it, it's called credit spreads. So the banks they operate and make money off of spreads. Credit card companies are banks. They make money off the spreads. And so they can borrow at LIBOR plus a little bit. They charge you LIBOR plus a lot more. They make their money and pay their people and pay for their buildings and everything else and all their marketing on that spread. The difference between what they borrow the money at and what you're returning the capital that you borrowed from them at that higher interest rate. It's that difference is called the spread. Now, installment loans and revolving credit has different impact on your credit scores. And if you think about credit scores are debt management scores. That's what they are.
Right.
So which type of debt do you feel is more risky? If you're thinking of it from a lender's perspective, is revolving credit more risky or is installment credit more risky?
Revolving?
Yes. Why is revolving more risky?
Because you don't have to get, well, you don't have to get it reapproved for every time.
Because it's available at any and all times. And it's available, like somebody could come get it immediately. You have a $500 credit limit, you've borrowed on it, you can go get $500 right now. If you have a $20,000 credit limit, you can go get it all right now.
But I feel like people's situations change. So when I got, like, you got approved for a card here, and this was your situation, well, maybe your situation is very different here, but it hasn't necessarily changed, and maybe you're not able to accommodate the payments, which is when you get in a lot of trouble.
So that's right. So when you miss installment debt payments, that is a big, big deal, because with a credit card, there's a minimum monthly payment. You can pay that. Most people can pay their minimum monthly payment. And you paying down a credit card balance, you're paying a little extra. That's great, as long as you make that minimum payment. Well, the monthly payment on a car is the minimum payment. And it's usually much larger than a minimum credit card payment for people. So the impact on credit scores of missing a payment is a mega deal. And it becomes even more of a mega deal when you're missing payments on vehicles, because you can't make partial payments. You can't make minimum payments to maintain that credit score.
Right.
Okay. So you may have been paying much more on a credit card, but it was way more than the minimum payment, but life happened. You lower down the minimum payment. Yes, your credit utilization might be higher, which will ding your credit a little, but it's nowhere near as bad as missing a payment entirely, like a car loan. And so you have to also think about your debt to income ratio. So when you think about, you borrowed the $35K for a car, that $35K debt to your income ratio, the debt payments to your monthly income ratio, immediately goes up that payment amount. When you get a new credit card, you have an increased credit limit, but if you don't use it, well, then your credit utilization percent of available credit consumed is less. Therefore, it can actually be a boost to your credit score. And especially as that credit relationship ages. One other thing to think about with your credit scores, when your car loan is paid up, you've paid it off, hallelujah. Well, then that credit relationship, one of the big things that factors in your credit score is payment on time and the length of that credit relationship. Well, that will still be on your credit report, but it becomes an aging, terminating relationship that will eventually fall off your credit score. And so that's why having a credit card that you can handle, paying it off every month and not paying that interest, can actually be more valuable to your credit score long term. Make sense? Yeah. Anything you want to add as we wrap this up?
It's so interesting because it feels like you're getting, I know I've mentioned this before in an episode, but it feels like you're getting penalized for paying your car off. I did the thing, I paid it off. Like, I should get some bonus points for that. Like,
you should get a gold star.
Like, you should, like, you don't make it come off my credit. Like,
you know
leave
what?
It on there.
We should offer free hand claps to anybody who pays off their car.
You need something.
So if you've paid off your car, comment below and we're going to post some clapping hands. Sound good?
They need more than that. We're happy for them.
Yeah, we are very happy. So, well, thank you so much for joining us for this episode of the podcast. We really do hope that this is helpful to you, helps you understand the difference between installment and revolving credit card debt, help you be able to manage it and be able to make wiser decisions with your money so that you can live a fully funded life. Hey, be sure to check out our Fully Funded Life community at fullyfunded.life. And hey, if you're ready to really make monumental changes, take that step to become a member at fullyfunded.life. Have a great week, everybody. Hey everybody, Joe Sangl here. Thanks so much for watching this video. Hey, I encourage you to click the links that are provided to watch a lot of more helpful content that'll help you live your fully funded life. Thanks for being a part of our community.